To be specific, if you looked at a framework here for mapping current account balances and how that then interacts with real exchange rate adjustments. So just start off by talking about the work that you've done here, and then we'll tie it to the US dollar.
Let me talk a little bit about that. But before that, the dollar has had a real roller coaster a couple of years. It went up massively 3-4 years ago. And of course, recently it's been more weaker. And so if you have U.S. policymakers, one person says, we're in favor of a weak dollar, we're in favor of a strong dollar. I have some sympathy for them because the thing has been such a roller coaster. The framework that we've laid out is the United States still has a big current account deficit. That is a reflection of us importing lots of things that we consume, which are not produced domestically. And the framework that we've laid out calculates that the dollar on a trade-weighted basis is still too expensive. It's about 10% too expensive.
Robin, so you look at valuations of currencies based on trade and the current account deficit. And what I'm curious about is, while it works in theory, does this work in practice? Can you actually... you could say that the dollar should be 10% weaker, but is this strong enough to actually feel confident that this is what the dollar is going to do?
Absolutely. That's a great question. So we've actually done a lot of work on backtesting this framework to see whether on a medium-term horizon, and I mean like 5 years, does this thing predict subsequent moves in real exchange rate? And the amazing thing, it does. So, for example, for China, which has been in the crosshairs for many, many years on currency issues, our analysis showed, looking back, that the RMB needed to appreciate from 2005 onwards. And lo and behold, that's what it actually did in practice. So there's a lot of information here. Obviously, the information works better when over or undervaluation is very sizable.
And so you've concluded that the dollar is 10% overvalued, particularly against some of the Asian nations.
Yeah.
Part of all of this is because, and you mentioned this earlier, with the tremendous moves that the dollar has seen, depending on what time period you look at it, there's a significant lag effect from the dollar's previous fluctuations. For instance, its strength from late 2014 to the end of 2016. Why is there this lag effect? Why does it not show up more quickly?
So first of all, I'm super impressed because you guys have literally read everything that we wrote.
We do the research.
Yeah.
So I have to say I'm pleasantly surprised. So the way things work in practice is, right, you are on the factory floor. You're exporting to country X, your currency appreciates, and so the goods that you're producing start to become less competitive because you're exporting in a currency that's becoming more expensive. Now, do you do something right away? No, because like everybody else, currencies are super volatile. They can go up, they can go down, who knows? So you're going to take it in terms of your profit margin and keep exporting and hope that the currency effect goes away. So it's only over time that people start reacting in terms of production levels. And so that's why there are these lags.
So if you've got a situation, and let's use the United States and China as an example, and the discussions that took place even just in the last week at Davos, and the tariffs that we've seen applied, if say those two countries say, okay, look, we're not happy, the United States clearly isn't happy, if we're going to make an adjustment over a 5-year period, say $75 billion, $100 billion to try and realign what we see as far as the deficit is concerned, how does that then impact the currency? Because currency markets move far quicker than current account deficits do.
Yeah.
Well, think back to the early days of the Trump administration when the border adjustment tax was something that was being debated, right? So that was a tax. Of course, there's been a lot of water under the bridge, and it's no longer on the agenda. But that was basically a tax that levied taxes on imports. And so basically the offset that the currency would have made had that happened, had that been introduced, the dollar would have appreciated significantly. Okay? So if we impose tariffs on other countries, the thinking is typically that exchange rates have offsetting effects. Now, I think the easiest way for China to deal with pressure from the United States on the currency and on trade is twofold. There's two constructive ways out for China. One is to let the currency appreciate. So we're calculating 10% adjustment, especially against the RMB and some of the other currencies in the region.
Okay.
And then import more services. The U.S. is a big exporter of services, so that's easy.
Robin, going back to the question of whether it really works, the connection between trade and currencies, I've seen it argued that in the global trade context where value chains are so technical and very specific countries make very specific parts that aren't necessarily even, that they don't even out the same way, and that you can't just sort of even out trade by having a currency adjustment. How does that thinking work into your perspective?
I mean, it definitely, so that's a really good point. Look, I think it is clear that if you look only at China's surplus with the United States, you're missing a lot of the picture because China is a final assembly point for stuff that gets imported from somewhere else.
Right.
And so it's not the case that all the value added is from China. However, I think you kind of need to take a bigger perspective and see the forest for the trees, which is China is a final assembly point for complex Asia, if that's what you want to call it. Current account surpluses in Asia are very, very large. Singapore has a surplus of 20% of GDP, Taiwan 13% of GDP, Thailand 11% of GDP. So no matter how you cut it, there's a big trade imbalance.
Robin, very quickly, when I asked my first question to introduce this segment, you made a comment about having some sympathy for policymakers who make comments about the US dollar. I assume we're alluding to Steve Mnuchin and the comments that he made in Davos about the relative strength of the US dollar here. Do you believe, in light of those comments, that anything has changed about the way the United States perceives the value of the dollar, or the reaction function here with regards to its relative valuation?
So the dollar is a market price, right? It's not actually set by U.S. policymakers. So I would say that, first of all. But
you can talk it around.
Yeah, you can definitely talk it around. What I would say is, look, the strong dollar policy has always been about the United States having legal and institutional frameworks that basically are supportive of transparency and good governance. That's consistent with a strong, stable currency. We still have that. We had that 10 years ago. We have that now. We'll probably have that 10 years from now. So I certainly don't think the dollar will be in free fall. And so I think these comments are a bit neither here nor there.